Hi there. Joining me today, cushionly from AIMA ACC, is Amit Agarwal, who's the head of stress asset strategy at Edelweiss Alternative Asset Advisors. So Amit, first of all, welcome and thank you for making time to join
Thank
us and speak to our global audience all around the world. I thought it'd be interesting to kick off and ask you more about yourself as opposed to Amit, the investment professional that the market has come to know. So perhaps you could tell us how interesting is it to be Amit Agarwal in from your vantage point today, so that we have a better sense of who you are. Amit?
Yeah. So I'm a chartered accountant and I belong to a small town in India called Lucknow. And I migrated to Mumbai for the job and pretty much have been doing almost for now more than a decade distress asset investing only. So, and distress asset investing itself is a very exciting profession. You meet a lot of colorful characters and you meet a lot of situations which always require on the toe thinking and require a lot of maneuvering to do. So outside of my job, which I truly love, I also have a passion for football, and currently me and my son watch Premier League together. And yeah, I'm currently being beaten, being Liverpool, I'm being beaten up by Man City. So
Right. Well, I guess you never walk alone uh, as a lifelong Liverpool fan, and I think there's no doubt, Amit, as many in the market can attest, and many of us would know, if you're a chartered accountant in India, you're super wicked smart. So I think you're definitely an expert uh, in terms of what we come on to speak about. So thank you for that quick self introduction. I'd like to now maybe turn to discuss and invite you to speak more about perhaps the size of the market, the opportunity set in terms of how you see it. So as I understand it, just based on reports and RBI estimates, India has more than 150 billion in stress assets. So my question to you is, how do you define the addressable market?
it's a very interesting question, Karen. I think the market size is huge, and sometimes we just uh, think that since the market size is huge, it will be like multiple deals and too many deals happening all around. But it's not so large in the sense that you have to find an addressable place. It's still very, very large as a market. So it is 25 to 30 billion in our estimate is really addressable market size, which is on the corporate NPA pool side. Retail NPA is giving up another opportunities, but I think 25 to 30 billion is our estimate. And we have done a lot of work on that. We have been investing for now almost 15 years, and we are one of the oldest distress asset investors. But just to say that $150 billion is there, let's go and do $10 billion of deal, it's not easy. uh, However, having said that, global capital has been coming in a lot, and we have been deploying capital as one of the premier players in the market. India has seen close to $2 billion of investments annually for the last 4 years, and these are very rough estimates, Kev. And India has seen $2.5 billion of high yield, distress, special sits sort of investments, which are high teen returns and 20% plus returns, sort of situations, gross INR returns I'm talking. And the opportunities have continuously come in. And therefore, the market also includes newer NPAs that keep coming into the market. So there is a stock which remains behind, and there is a stock which keeps on getting created as well. So there's no static number, but yes, if you want to go by the reports, it's $150 billion. If you want a real estimate on what everyone can eat, and this is even a large enough pie, is 25 to $30 billion of distress asset pie.
Okay, okay, that's very helpful. So out of a market size of 150, you're looking at 25, 30 potentially addressable market. So just as a follow-up, are there sizable opportunities and how should one think about investing in the space? Amit?
So I think there are a lot of sizable opportunities. I think the exciting part about India is that the opportunities of size have started coming in. We recently concluded a $300 million single transaction, which was kind of unheard of in Indian context. It was a consortium of investors which we led, but I think the overall sizes of transactions in India have gone up. Typically, India used to be a 50 million to 100 million sort of size of market, and deals used to remain in that ticket size, which basically led to a less optimal investment, in the sense that people were willing to put larger checks, but they were not having enough opportunities. But we believe that the right approach is to actually play the spectrum. So you do your deals of 50 million to 100 million, and you also do those couple of large ticket deals as and when you get the right mix of opportunity. So there are deals which are all the way up to 300 million, and the deals which are 50 million, and all are very significantly risk adjusted in terms of returns.
Okay. And I think what I'm hearing from you is the size and pace of deployment in the market is picking up. So I think that's very good in terms of setting a scene. You know, we get a sense the market and the opportunity set in India definitely present and growing as we speak. So I'd like to turn to and move us forward to a different topic, if you will, which is that of the legal and regulatory framework. Because as you know, the laws, the regulations, and also the taxation aspects, they very much drive deal structuring. So I wanted to get your views on how you see the landscape in terms of regulations and creditor rights in India evolve in recent times. Amit?
So I'll just give you a short history. So we have been investing since 2007-8 in distress asset, and the kind of change which bankruptcy code has brought to the whole regulatory regime was unheard of. So when we had started investing, all our investments were related to recovery of assets. So when an asset went bad, you went and bought over the assets. So if you were to enforce, you enforce the plant and machinery, land, but you were never able to capture the enterprise value. So you always used to get 10 cents, 15 cents out of a dollar in an asset where you invested. So the balance of power was in the hand of the promoters, who basically told you that either you accept a settlement that you need, that they like, or they will bring the asset to ground and you will not be able to capture the enterprise value. However, the bankruptcy code over the period of time has shifted the course of power. And now, with creditor in possession and the IBC code putting entire power with the committee of creditors, the whole balance of power has shifted to the creditors. In fact, the largest bankruptcies in India have basically thrown away one of the promoters in India, which everybody thought can never be displaced from their companies. Those promoters have also been displaced from the companies, which is what the success of bankruptcy law is. Again, to give you some perspective, prior to bankruptcy code coming in, we did not see any offshore investors coming and making sizable investments in India. We invested capital of almost $1 billion prior to bankruptcy code also, through our asset reconstruction company. And most of the resolutions was asset based, revival based, but it was always, almost always, with the existing management in place and helping them out. It was never hostile. However, post bankruptcy code, the investments have been made where people have taken up positions, bought out debt, and they have decided not to work with the existing management, take the company to bankruptcy court, and actually sell the asset out. And we have made several investments. So our fund is a $1.3 billion fund, and we've deployed almost 90% of the fund and across strategies. And we have seen exits in non-NCLT scenarios, we have seen exit in NCLT scenarios, and very successful exits. So the whole cycle has got established in the last 3 to 4 years. So the next 4 5 years are extremely exciting. We believe that a lot of capital is required for the country. There are high quality assets available, and flexible capital is the need of the hour. and therefore there will be a lot of opportunity set for special situations, distress credit.
Right, right. Flexible capital. I like that phrase. And so the code that you mentioned, just for the benefit of for people outside of India who might not be familiar, that's referring to the insolvency and bankruptcy code, which, from what I'm hearing from you, has been a massive game changer, and I think would set the market very well for
Yes,
more exciting action in the next few years. Yeah.
yes.
Um,
The
and,
good
and
part
you
also
mentioned that
is
it
that
has
a lot of judgments have also come. So any
right.
inconsistencies in the law have also been settled. So there are a lot of case laws which have settled a lot of issues, which, so the
I
initial
see.
hiccups are also over in the last 3-4 years.
Right, right. Okay, that's helpful. So the legal jurisprudence are also keeping pace with the development of the code. So I guess my final question on this point before we leave the legal regulatory framework is, so you mentioned the code having shifted the balance of power to more towards creditors. I guess, can we then conclude that this overall is also to the advantage of investors as well?
No,
Investors, say, in your fund.
definitely, yes,
Mm,
because the clarity of debt stack in India was not available before bankruptcy code. So whether the statutory dues were above you, whether the labor was to be paid first, whether there were unsecured creditors to be paid or not to be paid, there is a complete clarity of debt stack. And the financial secured creditors rule basically the entire committee of creditor, whatever is the commercial decision of that committee of creditor, that will get implemented. And there has been a good threshold of 66%, so it is not even like it's a very high threshold where small banks can actually withhold the process or hold the process ransom. So it's a reasonable two-third majority. If they are able to reach up a plan and agree on a plan, then effectively the code allows them to take a commercial decision. And right below the secured creditors, unsecured creditors, the government dues are even below unsecured creditors. So therefore, the government has also taken a lot of onus on them that they will not stall a resolution process, which is quite commendable in a country like India.
right, right. Yeah, I think that's very commendable anywhere in the world. I think not many people are aware that the threshold is actually set at 66%. So very good. Thank you for getting that word out on that. So just if we could move on to maybe speak a bit more about Edelweiss, the firm that you represent. So from what you've said, and obviously many market participants will know that Edelweiss has been an early player in this space. And I think you mentioned earlier, you guys have a long established track record going 15 years and more. So my question to you then is, tapping on this very rich experience of investing in the market, what are some of the factors that you consider when investing in a company? Amit?
Yes. So again, I think it's a very wide question, but I would like to take that up in a few verticals. So there are two or three types of investing. So first is basically where you do a debt buyout, where you are effectively buying out an asset from a bank. You have not worked with the existing promoter. You have not looked at the asset, but you are valuing the debt. It's like bond pricing or a junk bond purchase, where the access to data and all is limited. There, I think the domain knowledge and the understanding of the asset from the market sources is very important. Secondly, entry value is very important. So you really need to enter at a price where you are really safeguarded from any future downside. And thirdly, it is important for you to time it well, so that if you are entering into an asset, you should have a clarity whether it's going to IBC or going for resolution. This is pure debt buyout. We are just buying the debt out. You're not working immediately with the existing management. This is slightly a riskier strategy, but also has much higher returns. But given that if you know the underlying asset and you have a team, a domain expertise team, which knows that the underlying asset is doing very well, then you don't have a problem. So for example, when we bought over SR Steel debt, it was a completely a call on the asset, that the asset is almost 9% of India's steel production. So it will get sold definitely at a point of time. And the entry value that we were getting was much below the even setup cost of that plant. So that's how you do a analysis and kind of enter into an asset. However, the larger deals which are happening, which are sort of primary financing deals, as we call them, where you go in, you talk to the existing management teams, and you invest money for takeout of all the lenders together. So we recently concluded a deal where we put $300 million into a company, and 100% of the creditors took a one-time settlement and got out of the company. In that case, there are three or four fundamental things that you look for. You look for good quality assets, which is basically hard assets. So we prefer steel, cement, infra, where the downside risks are pretty low. uh, Secondly, you look at the existing management team, not the promoter, because management team is important, whether they will be able to run the company, not run the company. Thirdly, you look at the industry. So at what stage or life is the industry, whether the industry will be completely into shambles. And fourth, what are the basic control on debt that you get? So you should not be left hanging, that there should not be too many open areas, some creditor coming from here, from there, to stall your resolution. So you look at control, you look at asset, you look at management team, and then you do your deep due diligence. We took almost 4 months to do the due diligence in this particular asset, along with all our co-investors. And then you make investments at that point of time. So that's a very focused strategy, and you can do large transactions in that strategy. And third strategy is basically senior financing, where you effectively go to sellers who want to sell pools of asset, and then you cream it up. So basically you pay first 35-40% senior tranche, and you get high teen yields on those senior tranche, and the seller gets liquidity. So he is looking for liquidity, you are looking for senior subordinate structures, and there you do a diligence which is asset specific, but you take a call basis the pool, that in the pool, out of 10 assets, if 8 assets are good, you don't really worry about the 2 assets, because you are only 40% of the pool or 35% of the pool. So those are the various strategies that we follow across different deal types.
Amit, I was going to just say, as I was struggling with my mute and unmute button, I think that's a masterclass in investing in the distressed market. I'm quite sure many of our members will be replaying that segment of what you just shared. I think that's a lot of lessons in there, and probably some of your competitors as well who are trying to find your secret sauce. So I guess it's only natural, having heard from you in terms of how you see and what are some of the factors you take into account in investing in the space. Uh, how has your approach changed with COVID, if at all?
So I think last time when COVID first wave had come in, we had actually halted investment for some time, and because we did not know the extent of damage that COVID would cause, and we focused ourselves on handholding our existing portfolio companies, giving them time, effort, and basically telling them that we are partners and not typical lenders who will start going after them. And that approach actually helped us, and we had a very big recovery in all our assets within 3 months. So outside of May, June, July, August, 4 months of 2020, most of the companies were back on track fairly quickly. So the COVID situation, in fact, we do not see giving too much challenges from investing side, and neither from the exit side, because during COVID we exited one of our largest steel exposures. We sold that company to a strategic. We also found a buyer for one of our pharma exposures. So while COVID was going on, there were people who were looking for deals, and people who are rich with cash are looking for bargains, so you could create exits at that point of time as well. uh, However, from investment point of view, we continue to remain bullish on the core infrastructure sectors like structural steel, cement, infra. We do not do thermal power because of coal-related ESG issues. But outside of that, wind energy and other energy verticals, pharma, manufacturing, paper, we do all chemicals. So we look at all of these industries where there is significant amount of requirement within the country, and India is deficient in some of those commodities. So that has helped us actually grow our business. COVID has impacted more the retail luxury industry. So, for example, we had a hotel investment which is still suffering. So, the hotel investment, the hotel has not been able to recuperate. With the second wave coming in, I think there will be a little bit more bashing on that particular asset class. So, we are not investing as much in the retail and the hotel spaces as of now. And I think that area will continue to be a laggard. And that was never any which ways a core area for the fund. We see COVID throwing significant opportunities on retail pool of NPAs. So that could become a significant, because banks may be forced to downsell some of their retail exposures to either funds or ARCs or other people, and that could lead to some amount of opportunity building. But larger assets in India continue to operate very well, and there will COVID will throw some amount of displacement, which is only better for funds like us. Wherever banks are not able to provide those flexibility or terms, we can pitch in and give the capital, and things can get resolved for the sponsors.
Okay, so it sounds like very much business as usual, with some scope for additional opportunities because of displacement, and also the fact that banks might be retreating from the market. So very, very helpful. I think that sets us up very well to move on to the next topic, which is where perhaps we can come on to speak a bit about the challenges of investing in the market, as well as some of the success factors. So if I could start with perhaps asking you to invite your opinion on what are some of the challenges for special situations investment in India.
No, I think there are a lot of challenges. You can't make that sort of returns without some challenges. I think one challenge definitely which people feel is the sometimes the legal and the judicial system can be fairly slow. It can be painful, and we had envisaged, because we are from India and we know the situation. So we have actually envisaged like 2.5 years for resolution of a asset under NCLT, and this is SR Steel again. And a lot of investors who were coming from offshore, they said, "Oh, India is 330 days; it will happen in 330 days." And we said, "No, it is not going to happen in less than 500 days." So it's also about how much timing you estimate for yourselves. So legal process can actually be time consuming and can actually play on the nerves of some of the investors. The second, I think, pothole which you can face in India, which is very, very critical, and you have to be, is on ground monitoring and management of cash. Because some of these companies, because of their pedigree, wrong systems and practices seep into the company, and you have to go and plug the leakages. So you have to ensure that you have someone, your team or turnaround management, and you ensure that everything is put in a proper place to close those things. So if you do not look at that, if you just believe on the management, they may take you to the cleaners also at some time. So a very tight hold on the ground level investing is very, very critical and important in the asset. And third challenges which sometimes actually crop up in India is there are very few buyers typically for every asset. So you will have to look at companies where there could be more buyers if you were going for an exit. Because if you go for two small companies, the number of buyers is very limited. So the promoter is the only natural buyer. And given that we are not a very, very large or a very broad-based market, it is important to figure out what your exit path would be. Otherwise, you could remain stuck with the existing promoter trying to give you an exit. So those are the three pitfalls which one has to carefully evaluate while making investments.
Okay. So we spoke about the pitfalls, and I guess the flip side to that would be, what are some of the success factors? I mean, what are some of the key factors that drive success in the market?
Oh, I think success is clearly linked to you identifying the right asset, believing in its turnaround potential, working with the management team, working with them to deliver the results. We have seen fantastic turnarounds. In fact, one of the companies where we invested was at negative EBITDA when we entered, and for the last year, it will do $100 million of EBITDA. So, from a negative EBITDA to $100 million EBITDA is a significant turnaround story. A pharma company where banks did a one-time settlement of almost $100 million today could fetch an enterprise value of more than $300 million. So things can become really good if you are aligned to your objectives, if you have entered at the right value, and if you have persisted with the key things, which are, it's a very it's a very ground level work. You can't just sit at a distance and say that, okay, no, this will just make money for me on its own. So it's a very hands-on job when you're doing turnaround management and all. While debt buyouts
Right.
and NCLT exits could be a little hands off, could be a little more hands off than this.
Okay. So what I'm hearing from you is like many other places on earth, the turnaround story in India is very much alive and kicking, but like all other places, it's hands-on, it's intensive, uh, and there are success stories out of India as well, right? In a turnaround space. Okay, good. I think we've come, to a point of this presentation when I think the very clear message to everyone is plenty of opportunities in India. At the same time, it is a challenging, unique market, but there are also commonalities with other markets. So
One
I
more
think
small
on that
thing I would
note,
like to add before we close.
yes, go ahead.
I think India is
Mm,
also incrementally actually adding newer regulations, which are going to benefit the investors even more. So, for example, pre-pack resolution is also coming in, which will allow the existing
right,
management to work with the funds like us and investors like us to form a final solution and present it to the banks without having to go through the full NCLT process route. So the regulations are continuously evolving also to make the market better and more improved in India.
right. Okay, it's evolving and the best is yet to come. So before we wrap up, I thought it might be helpful to just ask you one final question, which is really how do you see the next 5 years of the Indian market in terms of outlook? So you mentioned there's a lot of innovation potentially coming. You mentioned one of them, pre-pack solution. How do you see the outlook of the market for the next 5 years?
So I think on the distress asset investing and special situation investing, we see significant amount of capital getting used up in India. Uh, there are three big factors for that. I think the banks and other large institutions are giving money only to very top rated corporate, and there is no mid market financing available from Indian banks. There's only working capital, retail, and only to top tier people any financing is available. So the need for capital in India is at an all time high from offshore funds. Secondly, the banks are very well provided in India today. They have taken a lot of provision on their past NPA assets. So their propensity to sell and actually book profits is high. And therefore, there can be a significant amount of sale which could be seen over the next 3, 4, 5 years in India. And last but not the least, the regulations continue to improve on all sides, whether it is pre-pack, personal insolvency, IBC, or otherwise. The things keep getting tighter and tighter. So, flexible capital, private credit, distress, special situations. I think a lot of capital India will absorb. And if I was to go by any estimate, at least uh, in 5 years, every year, if India does not absorb $3 to $4 billion annually, I think I would be very, very surprised.
Right, right. That's amazing. That's amazing growth and opportunity. So I think we've come to the end of time. So Amit Agarwal of Edelweiss, thank you for speaking with ACC and addressing our members. Thank you, and we wish you well.
Thank you.